I do think that we are past the peak level of the dollar and we're entering a more multipolar world where I think nations are rightly concerned around ongoing fiscal dominance and currency debasement, and then they're also concerned around their sovereignty of their own reserves. We are entering a potentially more dangerous world. Now there's more animosity between countries, and so there's more frictions involved now. If a country kind of gets heavily polarized, populist, and rips itself apart, that's when you get some of the more extreme scenarios like massive currency loss, 90% devaluations, the type of things you see in emerging markets or countries that have lost wars, basically. You also have to dodge financial repression, capital controls, and kind of targeted strikes at some of the assets you might otherwise be liking to own. The really two big supernational currencies I think we're talking about are gold and Bitcoin.
If nothing stops this train, what is the final destination here? What does that look like?
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori. Thank you for joining us. You're watching The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to show you what is really happening with money, markets, and power. And central banks have just crossed a major line. For the first time since 1996, they now hold more gold than U.S. Treasuries. This may be the beginning of one of the most important global rebalancings of our lifetime. That is the read from Crescat Capital, who charted the data. And this is just one piece of a broader trend. In a report published in June, the European Central Bank noted that gold surpassed the euro in official global reserves. And the record gold buying trend looks to continue. A new survey by the World Gold Council shows an overwhelming majority of central banks expect to increase their gold reserves in the year ahead. Meanwhile, gold continues to break new highs. Gold futures surged over 3,600, while spot prices for immediate delivery jumped above 3,578 per ounce. So, what does this signal about trust in the financial system, faith in U.S. debt, and potentially even the future of money itself? Here to discuss that and more is renowned macro strategist Lyn Alden. Lyn is also a general partner at Ego Death Capital, and she's the author of Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. In her book, Lyn shows how every monetary system, from commodity money to Bretton Woods to fiat currency, eventually reaches a breaking point. And she argues today's system is no exception, as it's straining under debt burdens, demographic pressures, and geopolitical fractures. And as she puts it in Broken Money, the endgame of excessive sovereign debt and declining trust in fiat is a search for alternatives, hard assets like gold, and increasingly decentralized digital assets like Bitcoin. Lyn, so good to have you with us. Thank you for joining us.
Happy to be here. Thanks for having me.
Well, Lyn, it is an excellent book. It's a really good read, and I recommend everybody pick up a copy. Want to talk to you about the book as well as some other big themes, but let's start off with what everybody is talking about, and that is, of course, the price of gold. We've crossed $3,500 an ounce. Gold is up around 36% year to date. And this week, we saw December gold futures hit an all-time high at over 3,630. And as I mentioned earlier, for the first time since 1996, foreign central banks are now holding more gold than U.S. Treasuries as a share of their reserves. We're going to pull up this chart from Crescat Capital that shows it very clearly. The yellow line, gold holdings as a percentage of foreign reserves, has now crossed above that blue line. U.S. Treasuries is a percentage. Now, to put this into context, back in the 1970s, gold made up over 60% of central bank reserves. It then fell for decades while Treasuries climbed. But now the reversal is happening, and gold holdings have just crossed the 30% level, while Treasuries have dipped below it. Now, Lyn, you have described gold as the king of commodities in your book. So what is your read on what is happening with gold right now? What is it telling us? What is gold signaling?
Right. There are two main parts that constitute this trend. One is that there has been increasing tonnage of gold owned by central banks. And so if you kind of zoom out, during that period where treasuries were very dominant, central banks were generally gradually declining their average tonnage. And that bottomed around 2009. And ever since then, there's been a gradual reaccumulation of tonnage of gold. And then, of course, the other component is price. As gold has appreciated and has performed very well over the past 5 or 10 years, while treasuries have been a very poorly performing asset class, the size of the gold market, and including the central bank owned portion of the gold market, has increased compared to those treasury holdings. So central banks that are making the right decision in that regard are basically getting rewarded for it, and those that have stuck to treasuries have generally been punished for it. I try not to read too much into multi-day, multi-week moves. Generally speaking, gold got somewhat overbought earlier this year, especially around kind of peak tariff uncertainty back in April. And so we went through a period of consolidation, which I think was healthy given the relative levels of if you look at the monthly chart, it was kind of historically overbought, which is fair to happen during these major structural changes, but still can get ahead of itself from time to time. So we went through a consolidation. They're still pretty rich in terms of these kind of indicators, but we did, I think, burn out a lot of that excessive sentiment. And so I think it is healthy to see gold at least trying to poke out to new all-time highs. We'll see how solid they are. I don't have a view on the near term, but I remain structurally bullish on gold going forward.
Okay, what do you make, though, of central banks buying gold at record levels, and as we saw, basically switching over to gold from U.S. treasuries? I mean, what are the central banks potentially preparing for something? I mean, I get that this is all part of the increasing de-dollarization trend after the excessive weaponization of the dollar by the Biden administration, with kicking Russia off the SWIFT system being a key trigger there. And that we did see how central banks were buying gold at record levels while ditching dollar reserve assets and treasuries. And we also know that the BRICS are creating a growing coalition to move away from the dollar, trading in their own currencies, moving away from the petrodollar, creating new payment systems. So, we have the US dollar's legacy role as the world reserve currency strained by debt levels, which we will get into, and political weaponization. And in Broken Money, you write about how international monetary systems rarely last more than a few decades before some form of restructuring or reset becomes necessary. So given those historical cycles and given the purchases of gold by central banks, are they buying gold in preparation for something?
I think they are, but I also think that a big chunk of what they're preparing for is happening now. These things tend to happen over periods of time, and for example, over the past 5 years, bonds have already been like the worst performing asset class around, pretty much. It's better to own almost anything else: equities, real estate, gold, Bitcoin, pretty much across the board. Anything other than currencies and bonds has been better to own. And so for a while, I think central banks are preparing for that particular period. I don't think that period's over yet. I think this is part of a longer term trend. Basically, ever since roughly World War II, there's been this trend toward the dollar and away from gold, especially accelerated after the 70s, and that has basically bottomed in my view. Gold hit as low as like 10% of reserve assets at one point, partially because of poor price performance and partially because I said before they were reducing their tonnage. I think that has hit like the generational bottom, like the century bottom, basically. And I think we're slowly coming back out of that, both from price appreciation and increased interest by central banks. One, they want to protect themselves from the potential of confiscation. We've seen, obviously, in the past administration, there was the freezing, both in U.S. and Europe, of Russian assets in response to their invasion of Ukraine. But then even in this current administration, there's these kind of punitive tariffs leveled on some countries. And so there's this more kind of global animosity or shifting of alliances. And I think that some of the things that countries took for granted, that they could hold all of their reserves in a security issued by another nation, or they could even hold their gold in another nation's vaults. I think a lot of that's been reassessed in recent years, and for good reason. I think that's healthy. So, not in addition to seeing increased gold tonnage, we've seen increased gold repatriation, where countries increasingly want at least a bigger chunk of their gold in their own borders. There's also shifting trade agreements. This is kind of the first time in a while that there's an economy as big as the U.S. economy, at least by some metrics. In some metrics, the Chinese economy is larger than the U.S. Other ones, they're still smaller than the U.S. But basically, there is this kind of centralized linchpin which can tie others like Russia and India and Brazil and potentially some others together for bilateral trade to flow through. So I don't think we're going to see anything like the post World War II dollar environment, but I do think that we are past the peak level of the dollar and we're entering a more multipolar world where I think nations are rightly concerned around ongoing fiscal dominance and currency debasement, and then they're also concerned around their sovereignty of their own reserves, which is gold and for some smaller nations, Bitcoin gives them that option to self custody their own assets.
Okay, before we get into the details of this multipolar world and what that could look like, I want to focus on one of the factors that has gotten us here, and that is the self-imposed weakness of the US dollar, the sovereign debt loop. And this all ties into your idea, as you say, that nothing stops a strain, that fiscal dominance continues, that, as I say, we're in a sovereign debt loop, keeping in mind that the national debt has exploded well past $37 trillion, more than 120% of GDP. And I always like to point out that the interest payments alone are projected to surpass $1 trillion a year. So just paying the interest on the debt is more than the entire annual budget for defense. So for those not familiar with your nothing stops the strain metaphor, and I know it comes from Breaking Bad, break that down for us.
Right. So yeah, that's from Breaking Bad, where basically the kind of villain protagonist of that particular show, he got so into what he was doing, his nefarious stuff, and he couldn't stop. Even when all the signs pointed to it being a good time to stop, he couldn't stop it. So he said, no, nothing stops his train. And I use that to refer to as fiscal deficits. Generally speaking, when you look at the long-term debt cycles of history, especially kind of the modern history, which in monetary terms, I define as kind of the post-telegraph environment. So the environment where money started to move around at the speed of light and credit started to detach from underlying hard money, even before official moves away from gold. So in this kind of, call it past a century and a half, there have been these long-term debt cycles where cycle after cycle, business cycle after cycle, private debt builds up and interest rates keep falling, until basically interest rates hit all the way to zero. And even that's not enough to stop potentially a big deleveraging. And after a period of pain, generally speaking, policymakers jump in and they say this is becoming too untenable. So we're going to basically rotate debt onto the public ledger. So you have a big private sector, partial debt deleveraging, especially relative to GDP. You shift over more to the public ledger. You build it up there. Last time we went through this in the United States was the 1940s and much of the rest of the developed world. And then from there, it really has nowhere to go other than to be burned off through inflation. If you're an emerging market country that tries this, you have debt often denominated in a currency you can't print, like the dollar, and so you're more likely to default nominally, much like a corporation or a household might. But if the debt's denominated in a country's own currency, then their default takes a different form, which is they still pay out every dollar or currency unit that is owed, but those are printed and those have much lower purchasing power than they had back in the years prior when those bonds were made, when those bonds were issued. And so I think we're in that cycle now, which is they've already shifted a lot of debt to the public ledger. This is all built up for decades. And now they're basically in their default cycle, which for a developed country looks like the combination of debasement and financial repression. So yields often do not keep up with the growth supply of money. And anyone who is either forced or voluntarily holds the currency in the bonds generally pays the price. And those that are shorting the currency where they can, basically taking out debt that's low interest and long term, like people who locked in mortgages years ago, they're generally getting their liabilities burned away while they have instead owned harder assets that generally appreciate in price while this debasement happens. And this can happen rapidly. You can have like a 5-year period where things reset pretty rapidly. In the current environment, because we don't have, fortunately, some massive war. There are of course conflicts, but it's not that type of kind of 1940s environment, at least current time. Cross our fingers. Instead, it's a lot of it's based on structural demographics, entitlement systems that were designed in a different era with different demographics that always assume the next generation is going to be bigger than the prior generation. Now we have more aged and top-heavy systems. In the U.S., we have very bloated healthcare expenses. And we are entering a potentially more dangerous world. The last 30 years were defined by kind of globalization Eastern labor and capital kind of, I mean, at least labor and resources coming to the market, Western capital coming to the market, these things combining into pretty efficient global supply chains. But that's also, there's been losers of that system. And now there's more animosity between countries. And so there's more frictions involved now. And so all these things that have come together, the US is basically locked into this period of high deficit spending. Which is sort of a type of kind of background stimulus at the cost of debasement, and so things tend to run hot. So that generally means better stock market performance than you might otherwise expect, better performance of hard assets like gold and Bitcoin. The real laggard so far is energy because there's really been no major supply bottlenecks there. And so energy is still pretty cheap, which helps keep official levels of inflation down. Um, but I think longer term, this whole trend is going to continue with 6 to 7% of GDP deficits in the U.S. basically as far as the eye can see, and then a handful of European nations in kind of a similar role.
Okay, but help us understand, if nothing stops this train, what is the final destination here? What does that look like?
Well, the final destination is a major currency devaluation compared to most other things. So compared to real estate, compared to gold, compared to high quality equities, you basically get a major currency devaluation. In extreme scenarios, that can end in hyperinflation. In scenarios more like the 1940s, that could your currency can get cut in half. It can get cut in 2/3. Anyone who's looked at the period, the performance of bonds compared to gold or compared to good stocks or compared to houses would see that that's not even a dramatic estimate. That's kind of already happened for the most part in a lot of developed countries. Um, and I think we're at a slower motion one. So again, because it's more of an entitlement crisis, a demographics crisis, and a political polarization crisis, more so than a major war. Instead of everything kind of happening in a 5-year stretch, I think it happens over a 10, 15 year stretch. So my general view is that we head into the 2030s. So we've already been in fiscal dominance for years now. I think this probably continues for the rest of the 2020s, and probably into like the mid 2030s, of just things running hot and currency and bonds continuing to underperform other assets. Now, what happens from there? I'd have to reassess as we get closer to that point. Basically, there are certain decision points along the way that can change my probabilities. But if a country kind of gets heavily polarized, populist, and rips itself apart, that's when you get some of the more extreme scenarios like massive currency loss, 90% devaluations, the type of things you see in emerging markets or countries that have lost wars, basically. Or you can, pivot, do a lot of policies that start making sense, stop the bleeding, and kind of, what is at that point there's basically been a default. Currency's been cut in half or cut in 2/3, but then they managed to stabilize. Um, those who saw this coming and were kind of positioned throughout it are in better shape. One of the other things to watch out during this whole time is you tend to get increased nationalism. We saw this in the 40s, and actually we're seeing it again now, which is basically more kind of top-down issuance of how things ought to be, potentially interfering with businesses, potentially increase capital controls and things like that. So that complicates the investing landscape because you could, in theory, you could on paper have all the right moves you want to make for this currency devaluation, but then the government can come in and say, well, your 401k has to own some bonds, or all pensions above this size have to own some bonds, or we're going to start telling equities companies that they have to do X, Y, and Z. And these kind of more outlier draconian things tend to become more likely when the sovereign itself is kind of flailing in its inability to stop the blood loss. They don't just kind of let it passively happen. They try where they can, at least, to shift the burden on other places. Now, compared to the 1930s and 40s in the U.S., we have a more polarized environment now, which is to say that, for example, back then, the president also had like 70% of Congress, basically a supermajority. That was a very unified environment. Culturally, we had kind of this mentality of like all in it together. Not us, but like our grandparents, and so that was a different environment back then. So now it's a messier environment. They don't necessarily have the same level of draconian things that they can just do. Also, media flows faster now, so people can meme about the government rather than read it in the newspaper like a week later. So it does change the landscape, but that is a very complicating variable So what otherwise is basically a straightforward thing. Short currency, own our hard assets. That's straightforward enough on paper. And just that added complications, you also have to dodge financial repression, capital controls, and kind of targeted strikes at some of the assets you might otherwise be liking to own.
Well, that's not a pretty picture you paint. On the political side of things, especially, and I get that you can't really make any calls yet because you need to see how things sort of evolve over time. But if nothing stops this train, what can slow it down? Because I believe that in your August newsletter you wrote that tariffs can help slow this down. How do you see sort of the Trump agenda impacting the speed of this train?
So some of the earlier moves were neutral to accelerating for it, which is to say, like the Big Beautiful Bill, for example, was kind of full steam ahead. The whole Doge thing was pretty minor. I mean, you can't really even point to Doge on like a fiscal chart. There's obviously
Good intentions.
certain programs were targeted, but they didn't really have the authority to go after the biggest things. So that was kind of not a big thing. The one that so far I think can slow it down potentially is the tariffs. And the reason for that is that most of the other levers like taxes and spending cuts go through a very polarized Congress where these things are unpopular. Tax increases are unpopular. Anyone who's targeted them will try to lobby against them. Also, spending cuts are very unpopular. So, especially the voting demographic that votes, people that receive Social Security, Medicare, things like that. These are very unpopular to cut. Defense spending is very unpopular to cut because many Congress people have certain parts in their district that are receiving that government spending, and they don't want to have that cut because their employees are voters in their districts, and so that's all very hard to untangle. At least in the near term, the president has used national emergency context to basically go around that. So by doing a tariff, which is a type of tax, but then saying we don't have to go through Congress because it's a national emergency, so we're going to do these tariffs. That's been able to kind of go through Congress. Generally speaking, you wouldn't see Democrats or Republicans have enough numbers to put in a tariff of these size, most likely. But the president's been able to do it pretty unilaterally. That's currently being challenged by courts. So a lower court found that it didn't work, but of course they appealed it. It goes up to federal appeals court. They also found that it didn't work. Now it's likely going to go to the Supreme Court, so those are still in effect. I'm not a legal scholar, so I'm not going to try to judge how that decision is going to go, other than to point out that unlike the prior decision, he does have the majority on his political side for this decision, but they have ruled against him before in certain contexts. So we'll see how that goes. But basically, to the extent that he's able to kind of do unilateral tariffs, it bypasses at least one part of the nothing stops this train thesis, which is polarized Congress. The part that it doesn't really stop is all the other parts, the demographics, the other big things that they won't cut, and the fact that even if you try a period of fiscal austerity without it going after the root issues, you're more likely to slow down the economy a little bit. And the problem is that unlike many other indebted nations, the U.S. is very financialized, meaning that we have a pretty high correlation between the performance of our stock market and then, by extension, the performance of our tax receipts. So if our stock market just goes sideways for a year, or even goes down, especially if this extends multiple years, with a minor lag of like a year, you start to get weaker tax receipts, which then blows out the deficit again. And that's a Gordian knot that's very hard to untangle without really addressing the root causes of a lot of this. So that's the part where I think nothing stops this train. But certain unilateral actions that kind of break the glass and go through polarization can potentially slow it for a period of time, either until those get big enough. Right now the tariffs, we're talking, annualized rate of 360 billion a year in the face of a $2 trillion deficit. There are scenarios where they go up to 400, 500 plus billion. So you're talking about a quarter of the deficit, or pretty small fraction of total spending. U.S. federal spending is something like 7 trillion, with like 5 trillion in tax in overall receipts. It's kind of round numbers. So these are material, but not game changing. And then of course the other option is the courts move against it, which still doesn't even necessarily end them. It just kind of gives them more frictions for how they might implement them in smaller, more targeted amounts. Again, I'm not a legal scholar.
Right. The president speaking out against this, saying that it unilaterally handcuffs him from his agenda. One of the president's other agendas is, of course, onshoring manufacturing, part of the trade rebalancing. Do you think that that could have an impact, right? He's trying to rebuild the industrial base, repatriate supply chains, have the United States become more self-reliant, maybe preparing the country to weather future geopolitical or financial storms without relying on adversaries. Is this something that could have an impact if we start to see this onshoring? We've seen some success. Apple, for example, arguably the poster child for cheap supply chains and cheap labor, is now pledging hundreds of billions into the U.S. manufacturing. So I think the total is up to 600 billion. I bring that as one example of creating a different dynamic here in the United States. Does that perhaps not stop the train, but could that dramatically slow down the train?
That I don't think so. I think tariffs have a more immediate effect. The movement of supply chains, less so. I think we'll see a similar phenomenon as Doge, but spread out over a long period of time. So if you look at the early days of Doge, they were always talking about these really big numbers that are happening, and saying if you kind of analyze this rate, it'll be huge. Also, they were doing a thing where if they cancel a contract that lasts like 5 years, they would kind of count off all 5 years of those potential savings up front, and things like that, kind of trying to optimistically paint the highest number they can, and then in hindsight, those numbers never really materialize, and then they kind of point to other issues. I think we're going to see a somewhat similar phenomenon with this, where it's much easier to pledge something than to actually turn it into reality, especially when it comes to physical supply chains. So generally speaking, I think that the incentive that corporations have is to try to make a pledge and then slow walk it until the political environment shifts, and to see what they can do. That's kind of the,
Right.
or get exemptions. So I think that while this is material, and I think it's going to be ongoing, I think that the trade deficit is structurally tied to the reserve currency status itself. It also has built up over decades. And so I think the way to think about this is that it's kind of a beginning of what could be a very long-term reversal. But I think people would probably, you can't really overestimate too much of what's going to happen in 1 year, 2 year, even a 4-year administration, because anything physical takes a long time. In the US, we have NIMBYism. There's the importance of the electrical grid. There's the cost. I mean, a lot of these things are in cheaper places because they're cheaper, right? So when you bring things more local, all the costs are higher. You don't necessarily have the labor that you need. Americans have much higher healthcare costs than every other nation in the world. So if you have them on your payroll, your health insurance that you're paying for your employees is very high. And so there's all these frictions that are hard to kind of actually make happen with a top-down enforcement. I do think it's correct for the administration to focus on the trade deficit as a topic. I think it's gone completely under the radar of prior administrations. But I think the tools that you use to do it, as well as the time frame that this kind of thing can happen in, are somewhat different than the identifying that it is an issue.
Right. And as you say, to function as a reserve currency, you need to supply with dollars and effectively run trade deficits, hence Triffin's dilemma, which I've explored at length with other guests on the show. President Trump also well aware how expensive it is to service the debt, so he's pushing the Fed, as we know, to cut rates. Markets are betting on the September rate cut, I believe over 90% chance now. We've also had some signs of weakness in the labor market. We just had job openings falling to 7.18 million in July, the lowest since September 2024. One of the few times since the pandemic we've been below 7.2 million. Latest ADP private payroll report showing cooling down in the labor market. So assuming this data is correct, given we have had some revisions from the Bureau of Labor Statistics, but assuming we're going with these numbers, this does accelerate the case for a cut. Are you expecting a cut in September? What happens once we get that cut?
I am expecting a cut. I think a cut is somewhat prudent. One of the challenging things is that in fiscal dominance, the central bank, like most things they do, can be argued to be a wrong decision because the fiscal deficits can fuel inflation. We still have above target inflation, so on the surface, a cut could seem improper. On the other hand, like basically the labor market is potentially weakening pretty significantly, and inflation is not way above target. In addition, the things that the Fed tries to control with inflation, which are mostly bank lending volumes, those are not excessive. Those don't really show the need for tighter policy. So I think that the sum of parts suggests that at least a mild trim makes sense. I do expect that they'll be cutting. Of course, one of the challenges is that unless they do outright yield curve control, the central bank only controls short end rates. And so just because they cut short-term rates doesn't mean it'll necessarily affect mortgages, longer-term duration treasuries, and things like that. In fact, their prior cuts didn't really contribute to this longer end. Now, a slowing economy combined with expectations of more cuts, that could potentially put downward pressure on the long end. I think we're seeing a little bit of that recently. So I think my base case overall is to have a slightly more dovish central bank going forward, partially because the metrics warrant it. And then two, starting next year, we could see just a different makeup of the Fed, a different chairman, and one that is more conducive to dovishness in this administration. So for multiple reasons on different time frames, I lean toward a more dovish expectations of Fed policy.
And how would that impact inflation then?
That's partially going to depend on fiscal. One of the points I've been making is that fiscal is driving inflation in this particular cycle. So if you look at basically like the 1970s, as an example, most of the money supply growth was coming from bank lending, fractional reserve bank lending. And that was largely because of demographics. So baby boomers were entering their home buying years. So you had a big generation entering their peak credit formation years. We had the highest ever kind of multi-year rate of bank lending, bank loan growth, of course, combined with physical shortages, oil, and the whole Middle East conflict. So that was like a 1-2 setup that gave us really high inflation. In the past 5 years, ever since COVID, instead it's not been excessive bank lending. Bank lending rates have been normal to even mildly subdued, and instead it's been very large fiscal deficits that were monetized partially by the central bank, which is more like 1940 style inflation. And then, of course, anytime you have a bottleneck, whether it's energy in 2022, the global movement of commodities, certain supply chain issues, things like that, you got frictions combined with rapid money supply growth from the fiscal side, combined with the central bank, and that's been inflationary. Going forward, there's not a lot the Fed can do about the fiscal side, and so they can keep an eye on bank lending. So I think if they mildly cut rates, you probably get a mild uptick in inflation. But you also, I don't think it's major. I think the bigger variables to watch are what's going to happen with fiscal side, with probably the nearest term outcome being what happens with the tariffs based on courts and things like that. And then the other big thing to keep watching is what happens with the energy market, because as long as the energy market is well supplied, we shouldn't expect major inflation for the most part. But if the energy market gets disrupted in any way, then I would expect inflation. I don't really see short-term disruptions on our path, but I would note that current oil and gas prices don't particularly support a lot of drilling in U.S. shale, and so we generally see a gradual rollover of production and drilling rates, which over a multi-year time frame can set us up for another energy price spike. So I generally think that inflation is going to be potentially a recurring issue,
Hmm.
but I don't really expect the type of 2022 inflation that we saw anytime soon, unless again something materially changes from my expectations.
Okay, so what kind of an inflation are you looking at? You don't expect 8% inflation, or what is sort of a number that you would project going forward? Assuming again that the government data is correct, assuming
Yeah.
that that's even an accurate reflection of inflation.
I expect us to stay above 2% for a while, so I think we'll be above the Fed's target for a while. I think 3 to 4% is a reasonable expectation. I also think we could continue to see a bifurcated inflation, which is to say that things that require a lot of energy or labor or other scarcity, so things like gold, Bitcoin, a house, especially a house in a nice area that's built well. potentially energy. These things are more energy or labor intensive. Same thing with like hospital services. And so they're more likely to track closer to money supply growth. So I generally expect more inflation out of those things. On the other hand, some of the inflation can be offset by, white collar wage suppression from AI becoming more competitive in certain fields, certain parts of the economy. So as companies potentially need fewer employers or graphic designers or accountants because people are increasingly managing AI to do some of that for them and increase the productivity of those roles. That can put some downward pressure on prices. The ability to buy accounting services, the ability to buy graphic design services, the ability to
Right.
buy software can continue to go down, offsetting some of that debasement. So I generally expect some of those areas to be in some ways surprised to the downside in terms of how disinflationary they are, depending on the rate of technological growth. On the other hand, I think that the truly generally labor-intensive things, blue collar labor, gold, waterfront property, these types of things, I think will still be mildly to up. We're not in a period of like massive money supply growth like we were in the 2020, 2021 period. With the lagged effects that, of course, went into 2022 and so forth. But I do think we're in a sustained, mildly run it hot environment, which puts us more in that kind of mid single digit range for a lot of things.
Okay. Look, I want to bring in Ray Dalio, of course, very well-known founder of Bridgewater, and he commented on X this week saying that if the Fed cuts excessively, if the Fed lets inflation run hot, what does that mean for bonds, the dollar, and America's creditworthiness? And he was replying to a question by the FT. And he said it would lead bonds and the dollar to go down in value, and if not rectified, would lead to them being an ineffective storehold of wealth and the breaking down of the monetary order as we know it. He went on to say the dollar and the other reserve currency governments' bad debt situations are threatening to their appeals as reserve currencies and storeholds of wealth, which is what has been contributing to the rise in gold and cryptocurrency prices. So that aligns with part of your thesis, right? So when he says the breaking down of the monetary order as we know it, do you have a scenario where that really becomes a tangible concern?
Sure. I mean, it comes in degrees. I would say over the past 5 years, it's already been a tangible concern because I would say bonds have already been a terrible store of value, and pretty much any other asset, including gold and other things, is a much better store of value. That's something that I've been arguing, and then to Dalio's credit, that's something he's been arguing, 5+ years ago as well. And so it's part of it is it's not just theoretical future things that can happen. This is already in a 5-year long-term investment time horizon, if not longer, has already had tangible impacts. Going forward, I think we'll see similar impacts, less extreme than some of those years, but still kind of trending the same way. Now, there could be punctuated by periods of mini crises. An example is the 2022 UK gilt crisis, for example, where there's more of a sudden shock to how things happen. So, for example, if you do get a Fed that is viewed as being more kind of directly politicized than the Fed's already has been, that can spook confidence in the bond market in a similar way that what happened to the UK gilt market. I try not to invest around specific crises because I mean they could happen in 2026, they could happen in 2028, they could happen in 2030. But I do think that over this time frame already laid out, so as we finish the 2020s and then go deeper into the 2030s, I think we're going to be in this period of kind of structurally higher deficits, ongoing debasement. And I think periodically in that time, you'll have these shocks. It could be that some major country decides to sharply reduce its U.S. bonds and hold other assets. It could be kind of something war related. It could just be major kind of loss of confidence in treasuries, which I still don't think we have seen despite their poor performance. There are still many people arguing for disinflation, many people arguing for kind of correctly pointing out that equities are very expensive, and so some of them will want to own cash and bonds, which is somewhat sensible. But as long as there's this kind of ongoing confidence, it supports itself. In addition, one thing to keep in mind is there's like 18 trillion worth of dollar-denominated debt held offshore. And that's mostly not owed to the US. That's mostly owed to other countries. Like some country in Latin America will owe debt denominated in dollars to China. And some entity in China will own dollar denominated debt to some entity in Europe, for example. And this kind of intertwined eurodollar system, this debt system, that all represents inflexible demand for dollars. Uh, and so you can have a pretty significant dollar sell-off. You could have a dollar index of 90 or 80, and yet you still have inbuilt demand for dollars to service existing debts, which takes time to shift over to other ledgers. So I generally expect that these things will take longer than people think. When people ask me when does debt matter, when does the crisis happen, I would say in the past 5 years it's already mattered, and that it will continue to matter. But my base case would not be as explosive as some people might suggest. But instead, we'll probably be talking about this 5 years from now, and there will have been more developments and more pain in the long-term bond and currency markets. But we'll probably still be using dollars for our purchases if we're in an area where that's normal.
So we'll probably still be using dollars into what time frame, you're saying? I mean, the point is, Lyn, we've had guests on the show that predict the end of the dollar as we know it, that the dollar will be dethroned as the global reserve currency, that there'll be a shift to a neutral reserve assets, although some have made the argument that you can still have the dollar as a unit of currency whilst having neutral reserve assets like potentially gold and Bitcoin, which we'll get to. But do you see a decline in the dollar over what time period? Like, what is your sort of outlook on the dollar when we take a look at, as we say, this debt, combine that with this bifurcation of the global monetary system and the powers pushing against the US and pushing for de-dollarization, the Shanghai Cooperation Organization, the BRICS. So give me your timeline for, I guess, the dollar.
So one is, I think that the Shanghai Cooperation Organization and BRICS, while they are relevant, I don't really expect a major currency that competes with the US dollar per se, like a shared currency. I think we already seen in Europe the troubles with a shared currency, like a shared monetary union without a shared fiscal union. So I think instead we'll see like increased bilateral trade and non-dollar settlement. So we basically will see increasing examples of Russia selling arms to India outside the dollar system, or China buying commodities from Brazil in their own currency, for example. And I think that'll be a gradual shift where then these countries have to hold less dollars because they don't need as much dollars to buy commodities or to potentially service debts. In addition, you could see some existing dollar debts gradually shift over to other ledgers, like Chinese currency. So you kind of pay off one and then you owe the entity in the other currency. And you see this gradual unwinding of the network effect of the dollar. I think that'll go well into the 2030s and we'll reassess from there. One thing I kind of point out sometimes is that I go to Egypt every year. We had 38% inflation and we were still using the Egyptian pound. So people often have these like extreme scenarios for what's going to happen in the U.S. in 1 or 2 years, and it's like that's happening in many places in the world, and people network effects and government enforcement are kind of a lot more resilient than people think, but that doesn't mean they don't break over time. So I generally expect ongoing structural dollar debasement well into the 2030s. It'll have been good to own. So it's not like saying that no problems happen till then, just like how problems have happened over the past 5 years, but there's been like one single crisis about it. It's just been this ongoing debasement with little mini crises here and there. I think that'll continue for 5-10 years. And, every year we get more data on what's happening. So I'm sure we'll have more points later, but I think that basically a lot of this will go on longer than people think, even as debasement is happening.
Mm-hmm. Well, I find that encouraging, personally. But big picture, you have made the point that every monetary system fails, that every several decades, there is a reset. And you did write in your book, the world is instead shifting towards a multipolar neutral reserve currency system, rather than a system where one country issues far and away the most dominant world reserve currency. No country, whether the United States or China or anyone else, is big enough to issue a fiat currency that the whole world can use and would want to use. The only thing that can be big enough is a form of supranational money, one that has natural scarcity, and is not issued by a government. Now, I get that you're saying this isn't happening necessarily within the next 5 to 10 years, but explain that scenario to us and what you think that supranational money would be.
Well, I think our first part of the discussion touched on that, which is gold flipped the dollar for the first time in a very long time as the biggest reserve holding of central banks. So that's like a first start, and it's still smaller than it used to be. We still are primarily, countries are holding the dollar and other currencies collectively are bigger than gold. But now gold is kind of both from tonnage and from price appreciation reasserted itself kind of, back into the fray. I expect that trend to continue over the next 5, 10 plus years. Bitcoin is about 1/10 of the size of the gold market. So it has more growing to do before it's interesting to kind of non-outlier sovereigns. So far we've seen El Salvador, Kingdom of Bhutan, UAE. They've shown some interest. Countries like that have shown some interest in Bitcoin at the sovereign level and have generally been rewarded for it. It's generally not big and liquid enough to be kind of interested to the larger countries. As Bitcoin gets bigger, I think it's also potentially in the conversation for that, and that you can see that that's part of the multipolar set of assets that entities can hold. But basically, the really two big supranational currencies I think we're talking about are gold and Bitcoin. Right now, gold is by far the choice. The interesting thing about Bitcoin is it also settles some of their concerns around payments. So gold is obviously it's a great store of value. It's harder to actually send. Generally, you use a chain of credit to do it. It's hard to actually send tonnage around. It's expensive. For example, Germany's repatriation of its gold took many, many years. Even though it came in faster than they expected, it still took years, and it cost millions of dollars to do. Whereas Bitcoin settlements, you can send $1 billion Bitcoin settlement and wait for multiple blocks to confirm on the blockchain and send it in like half an hour or an hour. So that is kind of this open source non-dollar network that countries could eventually shift to. But I think this will take time. I think again this will be one of those 5 to 10 year things as Bitcoin potentially moves from a $2 trillion network to a $5 or $10 trillion network. At that point, it's large enough where it's more like the size gold was 5 years ago, and then that's potentially pretty interesting at the sovereign level. So I think as the dollar has that kind of 5 to 10 year set of ongoing problems that I've talked about, like it already had over the past 5 years, I think that'll be the similar time frame where we'll see the ongoing. One, you see the diversification of currencies. So around the margins, a little bit more interested in China's currency, especially among all these kind of non-U.S. aligned BRICS type nations. And then two, you see this increased ongoing interest in gold and to a lesser extent, Bitcoin.
Do you see a scenario where you have both gold and Bitcoin as parallel neutral reserve assets, or is this for sovereigns, or is this an either or path?
I think so. The path over the past several decades was that basically sovereigns would hold gold for the portion of their assets that they hopefully plan to never have to sell. And they would hold treasuries for the portion that is generally more liquid, that they can liquidate in a day, potentially if they wanted to. And then, of course, there were various political reasons why they would hold more in dollars than they probably should have. And I think you could see a similar thing where sovereigns want to hold gold that they hopefully never sell, kind of like how I think many individuals should own gold that they hopefully plan to never sell and leave to their kids and just it's kind of rainy day gold. Whereas Bitcoin is more liquid, especially because it gets larger and quicker to move around. So I certainly think on the sovereign level, you can see that kind of by monetary standard where they hold both of them for different reasons.
Yeah. Lyn, I recall one of our interviews, and you pointed out that one of the things that Bitcoin was benefiting from was, this was about 3 years ago, bipartisan support. And we've certainly seen that happen. We have an administration now that is extremely pro-Bitcoin with a Bitcoin strategic reserve. Can we safely say that government and regulation is no longer a threat to Bitcoin? Are we comfortable taking that position, at least here in the United States?
I wouldn't phrase it quite that thoroughly. I would say that the threat that government's going to tell you that you can't own it has decreased rapidly, especially in the United States. Um, I think where there's still challenges are, I think there's still going to be ongoing anti-privacy rules that basically make it harder or disincentivize or sometimes outright illicit to use it in any sort of private sense. And two, I think it gets tied into that financial repression discussion I talked about before. When sovereigns have issues, um, they try to push the issues where they can. So I think that trying to surveil everyone's Bitcoin, making sure that they're taxing their Bitcoin, potentially in some context putting punitive taxes on people owning assets that whether it's gold, Bitcoin, foreign stocks, extra housing, whatever the case may be. There could be kind of buckets of investments that the government declares are desirable and that they view as contributing to the nation, and other ones that they view as more negative investments. They could put punitive tax levels on, which is different than saying you can't outright own it, but you just kind of layer on these frictions that are easy to kind of sell to the public. So I wouldn't say we're totally out of the woods in terms of government action against Bitcoin and related assets. But I think that some of the tail risks are mostly off the table, at least as far as like an investable probability analysis. And instead, it's more about how else can they poke it whenever they have an issue. And I think with the fiscal backdrop, they're going to continue to have an issue.
Right, and that financial repression may lead us into CBDCs, central bank digital currencies. I want to focus still on the Trump administration and its approach to Bitcoin. As I said, very pro-Bitcoin, established the Bitcoin Strategic Reserve, although U.S. Treasury Secretary Scott Bessent says that they're not going to expand the Strategic Reserve through direct purchases, but they're not going to sell off any either. He said the Treasury is committed to exploring budget-neutral pathways to acquire more Bitcoin to expand the reserve and to execute on the president's promise to make the United States the Bitcoin superpower of the world. What do you make of that? What are budget-neutral pathways? What do you make of the official government approach to a Bitcoin strategic reserve?
So when I did interviews earlier this year, I said my base case was that they would ring fence their existing coins, but probably not accumulate too much more. So far, that's the track we're seeing. They legally separated, their coins. They don't want to sell them anymore. They also put Bitcoin and other cryptos in different buckets, so they can sell other cryptos while they're not supposed to sell their own Bitcoin. So one of the budget neutral things they can do is sell other cryptos and use the proceeds to buy Bitcoin. That's one option. The ongoing confiscation of any sort of digital asset for any number of reasons could also be sold and used to buy more Bitcoin, or if it is Bitcoin, added to the reserve. So those are potential options. There are potential gold revaluation options, or similar kind of quote unquote budget neutral things that can be done to add some Bitcoin. I would expect to be pretty muted. They could surprise to the upside, certainly, but I wouldn't really base my investment decision on it. I would say that I'm bullish on Bitcoin without the U.S. government buying any more. And if they do happen to buy more, that would just add to the thesis. There are other things they can do to kind of add to quality of life of Bitcoiners. They can, for example, and this is some politicians have been focusing on this, which is to make it so that under a certain threshold, certain Bitcoin transactions are not taxed. Right now, if you buy coffee with Bitcoin using the Light Network, for example, that's a taxable event technically. And there are ways that can just make that easier. That allows more payment innovation without worrying about de minimis types of taxes, which I think would be healthy. That basically allows the citizens to use Bitcoin more rather than just stash it on the sovereign level. They can also potentially, strengthen their stance on privacy. So far, I think we've seen a little bit less anti-privacy action in this administration compared to the prior one. But there have been ongoing kind of legally troubling cases around privacy, even non-custodial privacy services. And so that's other things that I think are maybe not talked about enough when everyone's kind of focusing on the reserve. I continue to expect neutral to slightly up on Bitcoin reserve. And then depending on what happens with the next administration, depending on the next election outcome, I wouldn't particularly expect a Democratic president to add to it potentially could even reverse some of it, could go back to selling it, because that's only been done by executive order. That hasn't been, congressional law. So they would have it in their right to liquidate it on day one if they really wanted to. So that is potentially as ephemeral as other types of Bitcoin buyers.
So you talked about gold revaluation and using the proceeds to buy Bitcoin. That's something that Senator Lummis has put forward. You don't see that happening. Do you see gold revaluation happening in this administration?
My base case would be not in this administration, so not in the next 3+ years. When we look at a long enough time horizon, when we start talking about kind of the prior questions of what does this look like 5, 10, 15 years from now, I think that's more likely to enter the scenario where you have some sort of official devaluation to potentially pay off some of the debt. That's kind of a mechanism they have to spend without issuing bonds, is revaluing gold up. So I think in our lifetimes that could happen. My base case, not out of the realm of possibility, but my base case wouldn't be the next 3.5 years.
Okay. So while the government officially may not be adding to the strategic reserves, we are seeing the Trump family making Bitcoin a central part of its financial playbook. We had American Bitcoin debut this week on the NASDAQ after merging with Gryphon Digital Mining. The company mines Bitcoin. It's also a Bitcoin treasury company. It's co-founded by Eric Trump, who called it a historic milestone in bringing Bitcoin into the core of U.S. capital markets. Trump Media and Technology Group, which operates Truth Social, that's already become one of the largest corporate holders of Bitcoin, about 15,000 Bitcoin on the balance sheet. It's the 8th largest public holder of Bitcoin worldwide, according to my data here. So on a personal level, really leaning into Bitcoin, what does that signal to you?
I think there has been a shift. I mean, in Trump's first term, he was more anti-Bitcoin. And there's been I think it's been proven that in this, especially this past election, that being in any way anti-crypto and it's especially anti-Bitcoin is not really a winning strategy for elections. There's no marginal vote that a politician gets by adopting that position, and there are plenty of single issue voters and funders for being conducive toward the industry, and so I think that's a new trend. And then two, they find that they want to own it themselves. I've also been critical of the meme coin trend. I think that's a grift that we see not just in politics but just globally. So I think that there's some that have coined it the golden age of fraud or the golden age of grift, and I think we're kind of in this blend of politics and capitalism. And I don't know, it's an interesting environment. I generally am skeptical on a lot of these things. Like I've been skeptical on the size of the Bitcoin strategic reserve, skeptical on kind of the right types of policies coming, skeptical on kind of the citizens' right to financial privacy. And so I tend to take good news with somewhat of a grain of salt and instead look toward tangible things that are happening. And there have been some. It's certainly a better environment in the space. I think one of the other things that goes under the radar is Operation Choke Point 2.0. And so during the prior administration, there were clampdowns. If you were a Bitcoin or crypto company that merely had a bank account, there were all these attempts to kind of push you out of the banking system. There are many companies that had to go offshore that were just kind of facilitating payments and things like that. And the regulation environment has much improved for many of those. I wouldn't say it's over, and they're still raising concerns. There are those that are still raising concerns that this is not kind of fully addressed yet. But that has certainly moved in the right direction under this administration compared to the prior one.
Right. This American Bitcoin company, it's also a Bitcoin treasury company. And I want to bring the conversation there because we're seeing an increase of companies following the lead of Strategy, Michael Saylor, formerly known as MicroStrategy. And according to Bitcoin platform River, they put out a report showing that in the first 8 months of this year, Bitcoin inflows onto business balance sheets have already exceeded the total for all of 2024 by $12.5 billion. The report says that the treasury companies account for 76% of all business purchases since January 2024, 60% of publicly reported business holdings. So, with the concern of fiat dollar debasement devaluation, we are seeing companies use Bitcoin as a treasury reserve asset. And then you have companies that's their entire play, that the only thing they do is that they have Bitcoin as a treasury asset. So can that end up being a bubble, right? If we have this irrational exuberance potentially with these Bitcoin treasury companies, do you see that potentially going into a bubble? And if that somehow pops, what would that mean for the underlying asset, which is, of course, Bitcoin here? How does that potentially compromise Bitcoin's integrity, if it isn't indeed a concern for you at all?
So yeah, River puts out great reports. That one included. I had a chance to check that out. So it's a great report to discuss. The broader trend of could this be a bubble? The short answer is anything can be a bubble if it's overpriced or over levered. So I certainly think that this can get overdone for periods of time, and in some areas already has. So for example, when MicroStrategy was over 3 times net asset value, that was pretty euphoric. There were other ones with like MetaPlanet was over 6 times, and I think those teams are great. I think that those teams are doing very well, but investors can sometimes overbid the asset, and then it just depends on how well that's managed. I think that the market for companies that just have another business that then add Bitcoin to the balance sheet over the long run is longer than pure plays. But I do think that pure plays, if you're the biggest, most stable one in your currency, that's generally a pretty good place to be. So that's, for example, MicroStrategy in the US or MetaPlanet in Japan. I think it makes sense for some of these pure plays to pursue that strategy because they're the leaders, they're first movers in those environments, and they're being rewarded for it over the longer term. So then you watch things like how high are their MNAVs? How high is their leverage? So far, I would say there's nothing that's super concerning in terms of coming back and harming the Bitcoin network in any meaningful way. Every bear market in Bitcoin history has had some overexposed prior buyers that have to sell. Like last time we had Luna buying, Terra Luna was buying Bitcoin when things were good, and then when its whole thing was imploding, they had to forcibly sell their Bitcoin into the market. That was one example. You could certainly have that kind of thing happen again with some of these Bitcoin treasury companies, or more broadly, these other altcoin treasury companies. And that's where I actually would be concerned around more of the bubbles is in the altcoin space. But even in the Bitcoin space, it can get overdone. But Bitcoin is a proof of work network. Right now, the leverage in the treasury space is pretty manageable. And the MNAVs have already come down pretty significantly from their bubble heights. So, while I do think that if we have this conversation years from now, I think we'll be looking back at the bear market and say, look, this company XYZ had to liquidate its coins right in the bear market, and maybe multiple of them. So there will have been some capitulation. But I think the overall trend is fine, is how I view it.
Okay. Every guest that I've had on, and I bring up Bitcoin, I bring up the idea of quantum computing as a potential concern. They all say, ask Lyn Alden, right? From Larry Lepard to Luke Robin, everybody defers to you as the expert on what we can expect from quantum computing. I get you're not concerned about Bitcoin treasury companies. Let's talk about what could be a bigger concern. Do you see quantum computing as an existential threat to Bitcoin?
Not in the near term. Potentially longer term, it's one of the bigger hurdles that might have to be overcome. I try as best I can to defer to the technical experts in this area. So I directly talk to those who either are involved in quantum computing, those who have proposed updates to Bitcoin to further make it resilient against quantum computing, and things like that. Those that are trying to build companies that are addressing potentially some of the quantum vulnerabilities. The short answer is that Bitcoin is upgradable. It already gradually updates over time. Most of those are not consensus changes. Some of them are consensus changes, more rarely. And so with Bitcoin, the main vulnerability is not the core encryption itself. It's not as though the first time you have a quantum computer, it can just unravel the whole Bitcoin blockchain. Instead, certain signature types become increasingly vulnerable should there be a sufficiently powerful quantum computer. And so one of the first steps that people can do is, if they're in those generally very old address types, they can move them and take other practices to defend their own coins against potential security issues related to quantum computing, should it materialize faster than people think. And then two, the Bitcoin network itself does have some potential soft fork updates that can add new signature types that are more quantum resilient than even the better ones are today. Generally speaking, the downside is that they come with more block space. So in Bitcoin, there's kind of a limited amount of block space per block because it takes up bandwidth, it takes up storage. And so you generally don't want to use a bigger signature type than you have to. But should that day come, or should developers and investors get worried that it's coming soon, there are upgrade paths to protect it. So my general view is that it's not a non-issue. I have put considerable time into talking to the people that directly work on it in their programming or in their other capacities. And I'm satisfied that the Bitcoin network has methods to circumvent it. I also don't think it'll hit in an investable time horizon of, call it, 5 years. But I do think that I am glad that there are people that are already sketching out which signature types make sense, what types of upgrade paths would be doable, and things like that. So I don't view it as a likely existential threat, but I do think it's one of the ongoing serious risks that people do have to consider.
So explain, I know you have an engineering background, and I know you say you defer to the technical experts here, but explain what it means if Bitcoin would need to hard fork to upgrade. I mean, that would effectively create two chains as far as I understand it. Can you break that down for me?
So if it hard forks, now some of these changes can be done with soft forks, potentially. Other ones might require hard forks. If you have a hard fork happen, the chain would split into two. Ostensibly, one of them would be more quantum resilient than the other. And any current holder of Bitcoin would now have that number, but they'd have both coins. Now, historically, when Bitcoin has done hard forks, I mean, anyone can do a hard fork. I could do a hard fork this evening, just no one would buy it. So anyone can do hard forks. It's open source. But in Bitcoin's history, there have been a handful of serious hard forks, meaning that there's an amount of scale behind it. There are a number of large buyers, large miners, things like that support it. Historically, the hard forked coin, the one that's no longer backward compatible with the existing node network, that has historically not done well. That generally will fall in price and that value will get reabsorbed into the main chain. Now, should there be a scenario where quantum risks materialize and there's a quantum resilient hard fork, that's a possible scenario where the newer fork is the winner and becomes the new main Bitcoin. The way that users can protect themselves is if you just hold both coins, you get the benefit of whichever one wins. It reabsorbs the value of the other one. So, for example, when Bitcoin and Bitcoin Cash split, if you did nothing, you still hold all the Bitcoin you had pre-split, and you'll have an equal number of Bitcoin Cash, which is worth de minimis now compared to the Bitcoin, but you haven't lost any of the Bitcoin that you had. On the other hand, there were some, say, experts at the time that had very high conviction that Bitcoin Cash was not going to win, and so they could actually sell their newly generated Bitcoin Cash and even increase their stack of Bitcoin. So someone's high conviction, they could be right or wrong, but they can sell the fork that they don't think is going to win, double down on the one that they think is going to win, so it's an opportunity. But if someone's not sure, which is probably the vast majority of people, they just can hold both just by doing nothing, and they get the benefit of whichever chain wins.
So you're saying you would have a hard fork, you would have old Bitcoin and new quantum resistant Bitcoin, right? If I'm understanding you correctly, if hard fork is the way to challenge this. So, I mean, to me, then it just sounds like, okay, so now we have, double the Bitcoin. And I could be not understanding this correctly, but now I'm hearing I've got original Bitcoin and quantum resistant Bitcoin. I mean, what does that mean for, the whole argument of, limited supply? What does it mean for unchangeable hard money, that the rules are set in stone? If it has to fork into a new system to survive here, I mean, some would say that the rules can change when convenient. And if the rules can change, is Bitcoin truly hard money?
I would say yes, because it's not as though there's one entity that can just do a fork. The fork is decided by the market. And so, for example, when Bitcoin and Bitcoin Cash split, the market decides what is the true Bitcoin. Um, and so, by simply holding both, it is true that now there's 42 million coins because you have 21 million Bitcoin, 21 million of this fork, but that fork devalues. So Bitcoin Cash is worth like 1%, for example, roundabouts of the Bitcoin network. And so it didn't really take any share other than the first several months of that contest. So
Mm-hmm.
there's this kind of brief period of time where there's this narrative clash. But then when the dust settles, actually, I would say it was actually a strong case for Bitcoin being hard money because you had major exchanges, major miners, all trying to forcibly change the Bitcoin network. And all they did was basically create their own copy of it that then slowly disintegrated back into the main Bitcoin chain, at least all of its functional value. Um, and so Bitcoin as a software network can update over time, but kind of like how USB became USB 2 and became USB 3, and kind of like how Ethernet has, the Cat 6, Cat 7, Cat 8 cables that underpin network connectivity, they all update and get faster over time, but they're still backward compatible. They're still kind of their core system. That's generally how Bitcoin updates. And so it's this period of time where it does change, but it's not as though there's one central issuer of that change. It's a distributed network. And so only very high consensus changes are able to make it into the network and become the new dominant network.
So what happens if I have my Bitcoin in cold storage, for example, when should this upgrade happen? What does that effectively mean if I have my Bitcoin in cold storage and it's not, explain that to me.
You would hold both coins in this potential hard fork scenario. You would hold both coins. And if you just did nothing, you would hold both the types of coins indefinitely. And for example, if you've been holding, let's say, Bitcoin over the past 10 years in cold storage, when the Bitcoin and Bitcoin Cash hard fork happened, you now, like, let's say you had 10 Bitcoin. Now you have 10 Bitcoin and 10 Bitcoin Cash. And if you just did nothing, then fast forward 10 years to today, you'd still have 10 Bitcoin and 10 Bitcoin Cash. Now that 10 Bitcoin Cash would be worth almost nothing compared to the 10 Bitcoin, but you technically still have both, unless the Bitcoin Cash chain just gets so unpopular that it ceases function, which hasn't happened yet. But the main chain you still have. You even still have this other chain, and at some point, when you go back to check your cold storage, you can say, you know what, I don't really think I need this Bitcoin Cash anymore. For example, I'll sell it and either buy more Bitcoin or buy whatever, or you just hold it indefinitely. And so if Bitcoin were to have some sort of hypothetical hard fork in the future with some degree of consensus behind it or some degree of kind of split community behind it, simply by holding it in cold storage, you would still have keys to both sets of Bitcoin.
So it comes back down to consensus, which is how Bitcoin, gets its value in the first place, right? It comes back down to adoption, network, and consensus that we all agree that Bitcoin has value.
Yeah, because there's a network effect of liquidity. There's also a network effect of security. So, for example, the main chain, miners on that network could potentially 51% attack the weaker network, but the reverse is not true. So generally speaking, once a chain becomes the dominant one, it's very self-sustaining. And only during kind of very brief windows in time is it ever seriously challenged. Like, for example, back in the block size war, there's that kind of disagreement around store of value versus payments and who gets to decide when it changes. And the status quo won. Should quantum become a serious threat, and people disagree on how fast or in what way Bitcoin should update to it, there could be multiple different approaches, and then kind of the market chooses which one wins, which one kind of becomes or remains the leading network of liquidity and security for digital money. If for those that are not sure, you just hold the fork, you hold all coins, and then even as the dust settles, the weaker ones get reabsorbed back into whatever the main one is. It could be the one that already was, or it could be a fork that you still have coins of if you just did nothing.
So, Lyn, for the people watching this show, a lot of them are traditionally gold bugs, for lack of a better term, not in a disparaging way. And they would hear this and they would say, well, how does Bitcoin then equate to digital gold if it can effectively transform or mutate or upgrade? Like, what would you say to that?
I would say that it's a scarce network, right? So it's not going to accept a change that makes it worse, right? So for example, you can run your own node. You get to determine what version of the network you run. And so if someone comes along and says, here's an update, it basically increases the number of coins and gives those coins to person XYZ. I would say, well, I'm not going to run that update because that just makes Bitcoin worse. And that's why anyone can propose unpopular updates and they don't get absorbed into the Bitcoin network. Only extremely popular changes, things that fix a minor bug or things that potentially increase its resilience against attacks, quantum or otherwise, could have and historically have and potentially could get absorbed into the network as useful updates. Generally, those things are only things that make it stronger. Um, I think it's best looking at Bitcoin as a network effect communication protocol. So kind of like how Ethernet is very hard to disrupt. USB is very hard to disrupt. Simple mail transfer protocol is very hard to disrupt. Internet protocol is very hard to disrupt. Then you can look at social networks. I mean, people can make a million Facebook clones or a million Twitter clones, and it's very hard to displace the dominant ones at what they do. I think Bitcoin's in a similar capacity. It's a communication protocol of value. It's been the biggest for 16 years straight since it was developed. By far the biggest liquidity, by far the biggest security, basically the leading network effect in most metrics that matter. And I think that 5, 10, 15 years from now, that'll still be the case, and we'll reassess from there. And basically, it's this scarce. Basically, instead of relying on a nature to run your ledger, which is gold, and it's a useful way to do it. The other way is these big centralized ledgers, which is fiat currencies, and we've already spent this program discussing kind of the downsides of fiat currencies, all the debasement and defaults that can happen. And this other third option is a decentralized ledger. And then you say, well, if this thing is valuable, and many people have said it's valuable because you can hold an asset that no single entity can just snap its fingers and shut down. Then you say, okay, well, what's the biggest one, and does it have sufficient network effects and self-sustaining security to persist? And I would say Bitcoin has reached that state. And so when you compare, say, Bitcoin and gold, they've got pros and cons. I mean, gold is this 1,000-year-old monetary asset, and it has the downsides are that it grows something like 1.5% per year indefinitely. So you get that kind of long-term debasement at a pretty gradual rate. In addition, it has portability issues. So if you're living in Lebanon and you want to take all your gold and go to another country, good luck. I mean, there's certain, especially in fiscal dominance or capital controls or things like that, there can be all sorts of frictions against moving self-custodial money. Like I said, I live part of the year in the U.S., part of the year in Egypt. It's not like I'm not going to bring all my self-custody gold with me at any given time. If I'm going to have access to my own money, something like Bitcoin's more useful to have this kind of geographically segregated multi-signature setup, for example. And Bitcoin has that portability
Right.
that gold doesn't have, but it does come at the cost of there is this technical complexity. It's a 16-year-old network. It's 1/10 of the size. It's less understood than gold. And so there are these trade-offs between these two types of monetary assets.
Right. And, it brings me back to the book where you basically explain that money is effectively a ledger. And, when I first read the book, that really struck me. You write money is a ledger, and the more open and immutable it is, the better it is from a user perspective. The ability to store value in a distributed ledger that no centralized entity can change or prevent or debase is quite useful. And I know we're running out of time here, but very quickly explain this money is a ledger concept, because I think that's really at the heart of all of this.
Right. So anytime we're exchanging units of divisible liquid value, there's some ledger, some entity that we're kind of relying on to determine how many of those units are there and how does it keep record of how it changes hands. And one of the original ledgers is, of course, nature. So nature determines how much gold is in Earth's crust, where it is, how much energy and labor it takes to reach that gold, how much energy it takes to refine that gold into verifiable pieces. And so basically, At any given time, no one is sure how many gold coins exist in a given region, but there is an objective answer for that. That's basically governed by nature and physics, and the history of how many coins got there and were made and moved around. And the way it's updated is by physical possession, by exchanging the coin itself, or by to some extent by changing legal proxies of who owns that coin. But ultimately, it's about who actually has possession of the coin. So that's basically letting nature run a ledger of these tokens that we made out of nature's parts. The other main option in history is to use humans as a ledger, to basically say, well, this bank is the ledger. So if we both hold money at that bank, and I want to pay you, I can just tell the bank, deduct from my account, add to your account. Or the bank can issue banknotes, and I can hand you banknotes to just basically move around our units of the ledger. In a really big system like we have today, we have all these banks tie into central banks. So it comes down to one big national bank running the ledger that we use. So how many units of the dollar are there? Well, that's determined at the base level by the Fed, and at the broad level by a combination of the Fed, the government, and commercial banks. They collectively determine how many broad units are there in the system, tied into the base layer, which is basically the Fed. So we're relying on basically one group of individuals that are determining what is the kind of their lending rate for that money, and how many of those units are there. And so we have to rely on them to keep it stable. And they've already kind of they choose to have a long-term debasement. They basically want to have positive inflation, so they want to have prices increase despite the fact that human productivity goes up over time. So they want to gradually increase those units, and that they're operating the ledger so they have the capacity to do that. And then the third option is to say, well, instead of letting nature run it, and instead of letting just one entity or one council run it, there's a way now to run ledgers in a more distributed way. And it's more like a super large federation, you can think of it, or in a more distributed sense, it's potentially tens of thousands of entities participating in a ledger, and it comes with governing logic that is purposely very hard to update. So it's not that it can't update, but that updates can only be chosen by the network. No one can send out an update to all nodes. Nodes have to choose to say, I'm going to accept this update, and it's open source so people can audit it. And then they have this kind of ledger that they're operating together. And then if it's a proof of work network like Bitcoin, there's also an energy component into basically how that ledger is maintained. But basically, it's just this third option for running a ledger. So at the end of the day, money is kind of this divisible thing, this divisible liquid thing that we're moving around. And then just the main question becomes, who controls how many units there are, and what's the recording authority that determines who owns it?
Right. But money is just a representation of our time, our energy, and our effort that we can exchange with somebody else for something that, we may want from them. And the ledger analogy really resonates there. Very quickly, Lyn, can you give me a Bitcoin forecast for a year's time and 5 years' time, and a gold forecast for a year and 5 years?
A year, these things are very variable. I would expect to hopefully see Bitcoin over 150,000 in the next year. I'm not sure that's going to happen, but that would be my base case. Gold, I would like to see us touch 3,800, maybe 4,000 in that time. I wouldn't be surprised if it takes a little longer. When we look out 5 years, Bitcoin is very volatile, so I wouldn't be surprised if it, say, touched 250,000 or even multiple hundred thousands, and then corrected back down by some significant degree. But I think if we don't see 250,000 in 5 years, that'd be kind of disappointing, and potentially higher. For gold, in a 5-year time frame, I think of 4,000, 5,000, potentially much higher, becomes reasonable over those time frames. I'm always hesitant because there's information that could happen 6 months or a year from now that makes me change, but that's kind of the general trend that I would look at the current time. Maybe we'll look back and it's foolish, but that's my base case.
Well, my past experiences of chatting with you has been that your forecasts have been very accurate. But I get it, new data can change things. Lyn, as we wrap up here, what is your point of highest conviction for the next 12 months?
Point of highest conviction will be that nothing stops this train. U.S. deficits are going to remain large, and that owning a bucket of scarce assets is generally better than over-indexing on bonds and cash and things like that. Now, bonds can have a good trade, but I think this longer-term trend of not wanting to own bonds and wanting to own scarcer assets is still on track.
All right, Lyn, always a pleasure. So nice to see you. Look forward to seeing you in person again soon. Lyn Alden, where can people learn more about you, find you? Go ahead, give us the pitch.
People can check out lynalden.com, and they can also look for Broken Money on Amazon or wherever else they purchase books. Thank you.
Yeah, highly recommended. Lyn, thank you so much. Really appreciate it.
Thank you.
And thank you for watching. Please make sure to subscribe, follow us on social media, and remember, we love to hear from you. So, praise, whine, or just opine, we do read the comments and we appreciate all of them. For me, Michelle Makori, and the rest of the team, thank you for watching. We'll see you next time. Stay sovereign.
This is The Real Story with Michelle Makori.